The stock market and the companies that make up the major indices have changed drastically in the past several decades. But do you know how to manage the opportunities going forward? Today, we're diving into the future of stock investments and how you can navigate the changing landscape. And of course, we'll review the current state of the markets at the end of this video. Here's the problem. One of the key challenges investors face is keeping up with technological advancements, product and service innovations, and the market trends that impact investment decisions. Right now, we're living through a unique time in history where developments on multiple fronts are causing change to happen faster than we ever experienced in human history. If you think this isn't true, just look at the lifespan of companies over time as technology and innovation have accelerated over the decades. The lifespan of companies has been on a declining trend line, as you can see here. Let's explore together how you can take advantage of artificial intelligence, blockchain, new materials, robotics, genomics, and other rapidly changing technologies so you're not left in the dust. So how can you leverage these mega changes to optimize your portfolio to achieve your financial goals? Look, there are plenty of information resources out there to help you select individual stocks if that's the way you want to go, but it doesn't have to be that difficult. For example, you could just invest in the top 10 to 20 largest S&P 500 or NASDAQ 100 stocks and adjust your portfolio, let's say, once every year. This would keep you invested in the stocks that have outshined the others because they've fought their way to the top of that index. I'll also present a simple way for you to create a portfolio that will perform about as well or even better than the S&P 500, but with much lower risk using just 3 ETFs. The reason this method of using ETFs works is because the larger companies in the S&P 500 and NASDAQ 100 will most likely always benefit from the mega changes taking place right now. And if they don't, then they'll shrink to much smaller market capitalizations and become less significant contributors to the performance of these two indices. So what are we looking at right here? Well, if you've seen my previous videos, you'll know that this vertical axis is return, compound annual growth rate, and you can see it goes from plus 60% to minus 40% in this example. And then this horizontal axis is the maximum loss you would have incurred over the past 20-year time frame. So in this case, most likely in 2007 to 2009. And you can see that the S&P 500, represented by the ETF SPY, lost 55.19% of its value from its maximum sometime back in October of 2007 to the bottom, I think it was in March of 2009. That's a huge loss. So basically anything up and to the left up here is good. And as you get further to the right and down, that's bad, kind of represented by the colors here. So what are we looking at here? Well, I've created a very simple portfolio using 3 ETFs. And if you watch my video, The Ideal Portfolio Using ETFs, link in the pinned comments below, I walk through why you create a portfolio this way and how to do it. But we're going to do a brief version of that here. So what do I have? I've got 40% in safe haven assets. These are U.S. government treasuries. I have another 39% of my portfolio in what I call stable growth companies. These are consumer staple companies. So why are they safer? Well, when the economy goes to hell in a handbasket, you still got to buy toothpaste. You still got to buy razors for your shavers. You still have to buy medicine and drugs and all of those things that you need to live and food. These are consumer staple stocks represented here by the ETF XLP. And then 21% of the portfolio is in higher growth stocks represented by the NASDAQ 100. And you can see that here, this big green dot. Now, what happens when you combine the 3 of these together? Well, you end up with a portfolio that performs better than any of them. You can see that over here. Here's the portfolio, 100% of my assets. And by the way, these bubble sizes represent how much of the portfolio is in each one. So you can see this one's 21%, this one's 40%, and this one's 39% of the portfolio. So this is 100%. This is the entire portfolio. And you can see over this 20-year period, this portfolio had a 12.53% return, so almost as good as the S&P 500, which had a 13% return. But your maximum loss is less than half that of the S&P 500. So your maximum loss here is 19%. Now, you may look at that and go, wow, that's a lot. I don't want to lose that much. Well, you can adjust this and make it more conservative. But I'm showing you this to make a point here. You don't have to have a complicated portfolio to have an effective portfolio. And the importance of U.S. government treasuries is they add this nonlinearity in here, that the resultant portfolio over the long term will outperform the individual components, as you can see here. Oh, and one thing I almost forgot to point out, if you look at this portfolio, it has about the same loss characteristics as the aggregate bond index. There are no equities in the aggregate bond index. Now, there is some exposure to corporate risk because there's corporate bonds in the aggregate bond index, but people think of the aggregate bond index as a very safe investment. And you can see the maximum loss of this portfolio is about the same as the maximum loss of AGG, or the aggregate bond index, but the aggregate bond index only had about a 4% return, where this has over 3 times that amount of return. So this is a much better way to invest over the long term. So what have we learned today? Well, 3 things. 1, it's easy to manage your portfolio yourself with good long-term results. 2, you can take advantage of the huge technology shifts taking place right now without doing a ton of work and research. And 3, that benefiting from a simple 2 or 3 ETF portfolio can provide near or better returns than the S&P 500 over the long term, but even better with lower risk. The simple money management and portfolio ideas I just discussed could provide much more satisfying performance over the long term, both in terms of upside returns, but more importantly, in terms of downside losses. If you found this video helpful today, then don't miss out on future videos from my Invest Smarter channel. Take a moment to click on the subscribe button and share your thoughts in the comment section below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets.
Don't wanna let you down.
So if we take a look at how stocks performed over the last 5 days, now there was a holiday in the middle here, so we're going back actually to last week. But if we look back over the last 5 days, you can see that in general, we had an extremely healthy equity rally here. ARK Innovation finished way up here in first place, followed by the NASDAQ, followed by the S&P 500, followed by the Dow, and unfortunately, small caps are still lagging. And I don't think these are going to really take off until the Fed starts to lower rates, probably as early as September, maybe sooner. And if we look back over the past month, you can see that since June 24th, we've had a very healthy rally underway, with the NASDAQ first, S&P second, ARK Innovation is third, but you can see that the slope is much steeper here. And then the Dow fourth, and followed up by small caps, which again have been lagging. And if we look at year to date, well, you can see the NASDAQ 100 first, S&P second, Dow third, small caps fourth, and ARK Innovation still has a long way to go. And then if we take a look over the last year, you can see everything is up, but NASDAQ is leading the way, followed by S&P, followed by the Dow, followed by small caps, and ARK Innovation is starting to make a nice comeback here. So how do the equity bottom dynamics look? Well, not much going on here. They really have been waffling, as you can see here. You can see that the bottom forming indicator has been going up and down and up and down. The bottom confirmation indicator, same thing. And the confidence level, this dashed black line, has been extremely low. I mean, look at this. It's down here almost at minus 20. It kind of came up, tried to rally here, and then it's really been just hovering between slightly above zero and slightly below zero. So this market is extremely confused. It doesn't know where it's going. There's no sense of herd behavior right now. Everybody's out there doing their own thing. But how does that look when we look at risk versus opportunity? Well, a different picture here. You can see that risk acceleration, this yellow line, has just collapsed. It's below 20. It's way down here where I love seeing it. Risk, the red line, which is very much a lagging indicator, you can see started declining way back here and is continuing to fall. Now it's below 60. I don't mind this below 60, especially when it's on a decline like this. This is great. And then if we look at opportunity acceleration, the purple line, that started going up way back here and has continued to move higher, even though it pulled back a bit toward the end of this week. And then if we look at the opportunity level, this blue line, just like risk, this is a very laggy indicator. And you can see that it started moving higher and is continuing to move higher. So this looks very, very good. And what about equity versus safety? Well, if we take a look at equity versus safety, let's just jump into the overlay so you can kind of get a sense of what's going on here. So you can see that the NASDAQ 100 has been right up here in first place all along. This is great. Now, normally I don't like the fact that cash is moving up and that it now is in the top part of this table. But I think the reason for this is because Treasuries just collapsed this last week. And you can see that by Treasuries moving down in such a hard way, they've kind of floated cash, and gold is floating up a little bit, not just because Treasuries sunk, but because gold is also going up this week. So I'm not as concerned about this yet. I do like the fact that we've got the NASDAQ, S&P 5. Well, let's just go to the next one. I do like the fact that we've got the NASDAQ, the S&P 500, and the Dow in first, second, and third. Small caps are still way down here. They're not performing yet. But I like the fact that equities in general are way up here at the top. So not concerned yet about cash being here. But if cash starts to displace these equities up here, then we have trouble. And what about Treasuries? I already mentioned that they've really just kind of fallen out of bed here. So you can see that the longest duration Treasuries just collapsed from last week to this week, from third place all the way down to last. 20-year bonds from fourth place down to ninth. Not a good picture at all. Now, intermediate Treasuries kind of stayed put in the rankings, but short-term Treasuries outpaced intermediates and are actually doing better. Then you have cash above that. Now, gold is shooting up partly because these have fallen down and partly because gold went up this last week. So this is not looking good for Treasury risk, and I'm concerned about that. I don't know why Treasuries fell out of bed this week. And if you know, please leave a comment down below. I'd love to hear from you. What about the buying and selling pressure for equities? Well, you can see we've had a very nice movement higher for the Dow. We're still not above this peak back here, but it's been moving higher. You can see that the selling pressure, which was very high back here, has been falling lately, and the buying pressure has been on the increase. So this is good. What about the S&P 500? A much better price movement history. And you can see that while the buying pressure was up very nicely here, it has since started to decline as the selling pressure has started increasing. That doesn't look good. That's a divergence. So you've got an increasing price, but you have falling buying pressure and increasing selling pressure. We'll have to keep an eye on this. It worries me a little bit going into next week. What about the NASDAQ 100? Well, again, a very nice price movement higher. But again, you have the buying pressure peaked out back here and is somewhat on a decline here, while the selling pressure is somewhat on an increase. Again, a divergence here. I don't like that. So what about small caps? Well, small caps have had a nice price increase here. Not a very drastic one, but at least it was moving higher till the last several days. And you can see that the buying pressure has been steadily moving higher since way back here. Now, there is no divergence here. The buying pressure is moving higher, the selling pressure is moving lower, and the price is moving higher. So maybe this bodes well for small caps going into next week. Now, I said that last week, and then, of course, they bombed early in the week. So we'll see what happens. And then what about ARK Innovation? Well, ARK Innovation has had a pretty rocky ride, as you can see, but this price movement higher is really, really nice. It's very dramatically higher. And you can see that the buying pressure is moving nicely higher. And the selling pressure, this solid orange line, is falling. This looks really good. So again, maybe ARK and small caps do well the early part of this coming week, or maybe for the entire week. Well, like I said, just have to wait and see. Now, what about sector rankings? Well, you know, if you've watched my videos, these tend to be really laggy. We're kind of looking in the rear view mirror here. But if you look at both last week up here and this week, these look pretty good. I mean, you've got higher risk assets up here, technology, clean energy. You've got consumer staples, which moved up a tick. I don't like that. But I do like the fact that consumer discretionary moved up in the rankings. Now cash moved down. This looks great. In fact, here, just to make my point about these being looking in the rearview mirror, this is showing that treasuries are healthy, and we know they're not, at least not this past week. So let's take a look at sector rank acceleration, because these give you a little bit more of an indication where we're headed as opposed to where we've been. And you can see both in last week and this week, very healthy with technology up here at the top. You've got 20-year treasuries up here. I think these will start to fall when we get into next week. But you can see consumer discretionary made a big jump here. So let's take a look. Let's skip the chatter here. Let's take a look at what looks good in this chart. And there's a fair amount to look at. So you can see that here. I've drawn green arrows. The S&P 500 moved up. Consumer discretionary moved up. Consumer staples moved way up. That's good and bad. That tells me that that investors are putting their money in safer equities, but they're also putting them in riskier ones. So that's why I made this kind of a yellow-green line. And you can see emerging companies moved up here. Bitcoin moved higher, and cash moved lower. So there's a lot to like here in this table. Now, what is there to not like? Well, just a couple of things. You know, small caps moved down, no surprise there. And ARK Innovation moved down a tick. So those are really the two dark spots, if you will, in this information. Now let's take a look at treasuries. And as you can see here, over the past 5 trading days, treasuries have really not done well. They started out with a big downward move and then have been sort of crawling their way back up. Now, if we look from this point forward, this looks fairly healthy. You've got the longest duration treasuries here with the steepest slope up, the 20-year bonds next steep, and so on. So these longer duration bonds are coming back fairly quickly, and I like that. What about over the last month? Well, very much a choppy ride. You can see that. Things collapsed here, and now we're trying to come back. If you look at year-to-date, we're still down here below where we were back at the beginning of the year, and we've got a ways to go. We're down on the longest bonds, 8.5%. So, you know, a 10%, 11% increase would get us back to where we were just about 6 or 7 months ago. And if we look back over the past year, similar picture. We're down almost 12% on the longest duration bonds here. So these have to rally quite a bit just to get back to where they were 1 year ago. And what about the buying and selling pressure for treasuries? Well, you can see that in short duration treasuries, we've had a very nice increasing price here. You can see that the buying pressure has been well above the selling pressure and seems to be staying there. Now, it is declining here, and the selling pressure is starting to increase a little bit. So that doesn't mean we're going lower next week. We'll just have to wait and see how that one plays out. And then if we go to intermediate treasuries, kind of a choppier ride, but generally increasing prices. But you can see that the selling pressure has moved above the buying pressure, even as the price started moving higher here. So I don't know if I'd call that a divergence, because you can see that the selling pressure did decline while the price was moving higher. So this is interesting. And then 7 to 10 year treasuries, again, even choppier because they're more volatile. And you can see the same kind of upward price movement over the last several days. But you can also see, just like intermediates, the selling pressure went above the buying pressure while this was going up. And then if we look at 20-year bonds, TLT, you can see that the price action is even more choppy than it was with the other two. And just like the other two, the buying pressure has been declining as this has tried to move higher. And then more recently, the selling pressure broke above the buying pressure, even as the price increased. Now, the selling pressure is declining here, and the buying pressure is increasing. So that looks good going forward into next week. So really no divergence here, at least in the last few days. And what about that inverted yield curve? Well, we're still inverted. Now, we're not nearly as inverted as we were in the last several weeks, where this was approaching 50 basis points or minus 0.5%. So what's interesting about this yield curve is you see that a year ago, rates at the short end, at the 1 year mark, were well above where they are now. So rates down here have been falling, even though the Fed hasn't been lowering them. Now, once the Fed lowers rates, these will really drop. But I think these are dropping in anticipation that the Fed is likely going to have to start lowering rates. And speaking of that, when the Fed meets 3 weeks, 3 days, 18 hours, and 43 minutes from now, right now the market consensus is saying there's a 93% chance, let's call it, that the Fed will leave rates exactly where they are. And you can see that that has actually been going up since last week. So almost no chance the Fed will lower rates, only about a 7.2% chance. Now, different picture when we get out to September. This has been dropping dramatically. You can see just from last week, it went from 35% down to 22.3%. So I think the markets are starting to recognize that, yeah, the Fed's probably not going to lower rates in July in just 3 weeks. But by the time we get to September, they're almost certainly going to have to lower rates. And what about gold? Well, we talked about the fact that gold has been moving up, and you can see that here. In fact, over the last couple of weeks here, it had a very strong upward movement. So that showed up in some of the rankings that we saw. But you can see that the buying and selling pressures really have not been making any big moves like they were back here. So yeah, currently the buying pressure is moving higher and is above the selling pressure, and the price is moving higher. So this looks like it possibly could go higher, but I'm certainly not going to call it, because you can see it's extremely volatile and unpredictable. And what about Bitcoin? Well, Bitcoin has really been struggling, especially lately. You can see here we had a very big decline, a very steep decline here. It tried to come back, and a big drop on a couple of different days last week, with a huge spike upward in the selling pressure. This doesn't look great for Bitcoin going forward. As you can see from the price movements and the metrics for equities, the equity markets are trying to move higher, with the NASDAQ 100 and the S&P 500 leading the way. And Treasuries have been trying to recover from the recent pullback. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media. with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.